Good evening. Welcome to Aldersgate United Methodist Church. My name is Carrie Beckenhauer. I welcome you, everybody who's here in person. We're glad to see you, and also welcome everybody who's online tonight. I'm part of the Lasting Legacy team that is putting on this series of presentations. This is our 7th presentation. This is our final presentation for this year. A couple of housekeeping things before we get started. One is that the restrooms are out the double doors to your left. Down the hall, you'll see the water fountain, and then you'll know you're in the right spot. Also, you'll notice we have emergency exits on every wall of the sanctuary. Not that we expect to use them, but just in case. Also, if you brought in a glass of water or a plate with fruit or something on it, just please take your empties back to the tub that's in the fellowship hall across the way. So typically what the speaker does is he'll talk for 30 to 40 minutes. We will have question and answer after that. We'll have a wireless mic that we'll bring around. And the reason that we need to use the wireless mic is so people online can hear the question. Everybody here can hear the question, but people online need to hear the question. So our speaker tonight is Brad Eworth. Brad Eworth, CPA, Certified Financial Planner, is the president and founder of Eworth and Associates, CPA, PC, and P23 Financial Incorporated in Lincoln, Nebraska. Mr. Eworth has been helping families in numerous states for over 40 years with tax and retirement planning. Mr. Eworth has a unique way of coordinating the retirement and tax planning process, helping to minimize the impact of taxes. Additionally, he walks along with his clients, guiding them with basic and advanced tax reduction strategies during their financial journey. Mr. Eworth is a lifelong learner and continues to participate in various conferences and self-study courses, and is a member of several high-level tax planning groups. This allows him to maintain leading-edge concepts while helping his clients. Active in his community, Mr. Eworth has coordinated the Alpha Christian program for more than 15 years and has volunteered at the People's City Mission, the Center for People, and is a former teammate. Additionally, he supports the Fellowship of Christian Athletes and is a member of the Board of Directors for Make-A-Wish, Nebraska, and was formerly board chairman. Please join me in welcoming our speaker tonight, Brad Eworth.
Well, thanks, Gary. Thanks for having me here. I'm Brad Eworth. I own my own practice in Lincoln, and I'm talking about tonight taxes that most people really hate to talk about. And so, it is what it is. But I try to help my clients do more planning so they're not as fearful when they come into my office. Many times I've been told that coming to my office during tax season is like going to the dentist. They hate coming there. So I try to make it a little bit more tolerable during that process. I do also do I call it basic tax planning, and also advanced tax planning. And tonight I'm really going to talk about more basic that may apply to more people tonight. Advanced is an area where it's really based on income, and it's pretty high income. And so, but I do a lot of high-level tax planning as well for individuals, either for current tax issues or for retirement issues. And we'll get into some of those pros and cons as we go. Why would you want to be considering proactive planning? Any ideas why you'd want to do that versus just preparing your tax return?
Some stuff has a deadline.
Yeah, deadline, and most people don't like to pay taxes unless somebody here does. They want to pay the least amount as possible. And usually if you go to a CPA, a lot of times, they're going to prepare your tax return. I was in a big firm called Pete Marwick, and in regional firms and local firms, and even those big firms, a lot of the concentration was on tax preparation and not so much planning, surprisingly enough. And so it takes a different mindset to do planning. And if you really need to think about how to reduce tax obligations for your clients. It's really a different mindset than preparation. So that's why I think most people should consider it going forward. So what would you consider the first question you should be asking when you do any type of tax planning? Any ideas there? And it really makes a big difference when you think about this. For me, when I talk to clients, is the first question should be are you looking to do short-term or long-term planning? Because sometimes they are conflicted with each other, okay? Because short-term planning to me means tax reduction in the current year. Long-term planning may be meaning trying to get tax reduction in 5 or 10 or 15 or 20 years, or for beneficiaries. And so the first thing you should be really thinking when you do tax planning, when I talk to my clients, is what's your priority? Is it short-term planning or is it long-term planning? So when we get into planning, and I tell this to everybody, I wish it wasn't this way, but the value of planning really depends on your income, your filing status, and your goals. So, and a lot of times, when I do a lot of calculations for clients, it really depends on your income. And so, and it's easier for some than for others. I mean, sometimes the client may not have enough, or the type of income they may have makes it somewhat difficult to do any significant planning because there's not a lot to work with. So, when I get into planning, here's some things that I think you need to understand. These two things here are instrumental in doing any type of planning. The tax rules, obviously, which are changing all the time and are complex. I think Congress makes it that way for whatever reason. I don't know why, but they do. And then brackets. And when I talk to clients, especially with a high level of planning, brackets will determine the value of planning. So let's look at some brackets. And then it's hard to read up here, so I have you look at your sheet. I want to just bring out a few things to notice on here. These are the federal tax brackets for single and for married filing jointly. You'll notice that the big jump is between 12 and 22%. So you have a 10% jump, and then you go from 24 to 32% is another big jump. And this is based on taxable income. So when you get into planning, because brackets matter, if you were in that $110,000 range and you knew your next dollar would be going into the 22% bracket, maybe you want to do something to not have that happen, okay? Many times, people believe, erroneously, that if you go into a bracket, if you go into the next bracket, that bracket is for all your income. So say you're in the 12% bracket and you just go over the hump and go in the 22% bracket. Many clients of mine used to think that once you enter that bracket, all your income was at 22%. That is not the case. You always maintain the brackets behind you, so you never lose the 10 and the 12 and the 22% bracket, even though you went into the next bracket. The bracket matters because the next dollar is what it will cost you. Okay, does that make sense? So if you were at the $100,000 range and you're in the 12% bracket, and you make another $5,000, a lot of that will be in the 22% bracket because you're going into the next bracket, but you don't lose lose the brackets behind you. So the next chart gives you an idea how that works. So if you're in these, if you have these amounts of taxable income, you can see even though at $200,000 you may be in the 22% bracket for most of those dollars, but you never lose your brackets behind you. So you can see here on this chart that even at $200,000 married filing jointly, your effective tax rate is 17%. So again, you don't lose the brackets behind you. You don't go into the full bracket. Does that make sense? So it does matter. And the important thing is brackets matter when you go up and when you come back down. So many times I do calculations for clients because when you do a tax planning strategy, if you're in the 22% bracket and you do a good strategy, you may come down a little bit. So part of it values at 22%, but some of it may be valued at 12% because you're coming back down the bracket. So brackets are bad going up, and they could be bad coming back down because the value may not be there. And the value of tax planning is to make a lot more benefit than your cost. Does that make sense? So, okay. Another thing is, does it matter where you live as far as your taxes go? I'm not talking about 84th Street or 70th Street. I'm talking about not in Nebraska. Does that matter really? Does it matter that much? Maybe. Does anybody know how many states there are that don't have income tax? Guess? How many?
17.
Nope. 9. Right now there's 9. New Hampshire just became, in January of 25, just became a state that doesn't have any state income tax. Florida, Wyoming, South Dakota, Washington, Alaska, Nevada, Tennessee, and of course Florida has no income tax. And I talked to a client 2 days ago that was considering, again, his tax plan, which I talked him out of. His tax plan was to move from Nebraska to Florida to not pay any income tax on his earnings. That's okay, but if you know what Nebraska's rate is, right now it's 4.55% is the highest bracket for Nebraska. That will go down to 3.99% in 27. So when I talked to my client about that, it wasn't worth to him to leave, and his wife was very happy with me because I told him not to do it. So, but it wasn't worth it to him to leave the state for 4.55%. Most people would probably pick either Texas or Florida. Don't see very many people going to Wyoming or South Dakota or Alaska to save taxes, but there are some states that don't have any income tax. So again, tax rules and brackets matter. We talked about brackets. So now I'm going to talk about some basic rules because I didn't know the topics that everybody wanted to talk about. So I'll talk about basic rules, and then we'll talk about some areas that I think some people may have: retirement, real estate, capital gains, that kind of thing. But the next thing is to talk about standard or itemizing your deductions. And there's pros and cons to this. Does anybody know what the standard deduction is for this year, 26? For married filing jointly, not single, married filing jointly. $32,200. Mm-hmm. And that came in about 2018, the standard deduction. And I'll tell you how it kind of created some problems for some charities actually, because the standard deduction went way up. And so, and I'll tell you how it kind of plays into here is that the four main areas of itemized deductions, and I asked you that, but it's on your sheet. So you should know by now. I was going to ask a question, but it kind of gives it away, but there's 4 main areas now for itemized deductions. So what you do is you look at your actual deductions, and you have to exceed, if you're married filing jointly, $32,200 plus, if you're over 65, $1,650 per person. So, that's a good thing. You don't need to do anything to get it, but also you got to be careful from a tax planning standpoint. If you're doing things you thought you were going to be able to deduct and you didn't get any benefit from it. So here's these rules did change a little bit in 25 and 26. Medical deductions, and you may know this, has to exceed 7.5% of your gross income. So if you have insurance and you have any significant income, it's hard. It's hard to get over that threshold, 7.5%. So if you made $100,000 from 401ks and Social Security and capital gains, you got to exceed $7,500 just to start, just to get in the pot. Okay. Mortgage interest. If you have a home and you have a mortgage on your home, of course you would have mortgage interest, and a lot of people pay that off. And so a lot of times you don't have any mortgage interest, so harder to get up over the threshold. Taxes are made up of real estate taxes, Nebraska taxes paid either through withholding or estimates, and motor vehicle taxes. Those are your taxes. Now in 2024, that threshold is called the SALT deduction, SALT, and it's been around for 18, I believe, was the year that went into play. And the people on the west and east coast were furious about this rule because no matter where you lived in 24 and prior to that, no matter where you lived, the cap was $10,000. So state income tax in New York, California, real estate taxes, it didn't matter. You only got $10,000. So they were, when that bill was going through, they were really upset, okay? In 25, with the new tax bill that was signed in July 4th of last year, that threshold went to $40,000. So what you saw many times in 25 and 26 going forward, you saw maybe some people were able to get over that threshold because the limit went from 10 to 40. So with the real estate taxes, state income taxes paid, whatever it may be, it allowed people to maybe get more deductions than they were able to get for the last probably 8 or 9 years. And so that was a big, big deal for a lot of people that threshold went up. Donations, and so I'll talk to you about a little bit about standard deduction and why this started to hurt some charities like churches and that kind of thing, is because here's an example. We know the standard is $32,200, okay? And say you're not over 65. And you don't have any medical to get over the threshold. You have some taxes, say you have $10,000 in taxes, no mortgage, and you want to give the church $25,000, okay? Well, your benefit is $3,000 on your tax return, times your bracket, because you would have got $32,200. Now you got $35,000. So that rule, when the standard deduction went up, a lot of charities were concerned because they were concerned that people were not going to give if they're giving just for tax purposes. Now, when I was interviewed many years ago on Channel 8, and I told them when this bill was coming through, I told them I hope people will give out of their desire to help fund charities or churches or other types of things and not do it just for tax purposes, because if they're doing it just for tax purposes, they may not do as much because they're not going to get a tax benefit, because doing nothing, you got $32,200. Does that make sense? I mean, it's a pro and con. Okay, so that's brackets, standard deduction, which I consider basic basic knowledge on some tax issues, because some people will only be able to do some things with itemized deductions. The other thing with donations, let me just make sure you remember this, is that in 26, so let's say you know you're not going to be able to itemize. You know you're going to take the standard deduction of $32,000. So whoever's doing your tax preparation, you don't even give them the information because you know you're not going to itemize. In 26, even if you don't itemize, you get married filing jointly, you get a $2,000 charitable donation. So make sure whoever's doing your tax return, you remember that even though you don't itemize your deductions, you will get a $2,000 deduction for charities that you give to. $1,000 if you're single. So that's brand new for 2026. So again, if you didn't know that or you didn't provide that data, you would not get that deduction when you go to file your tax return. So yes.
Do they think that will increase the amount for charities and reduce that gap?
I think that was probably their hope, was that they would get more people to start giving again, even though they were before that they wouldn't get a benefit. Now you get a $2,000 benefit, so hopefully people will at least give $2,000.
It's communicated.
Right. Yeah. And so that's brand new. The other thing that came about, you may have heard of this term that came about because of these rules, donor advice funds. Donor advice funds came about because of tax issues, mainly, I believe, because donor advice funds allows you to give money to a foundation or a location or an entity that you get the full deduction in that year. But you didn't want the charity to get that in that year. You wanted to spread out over numerous years. So say you're close to being able to itemize and you say, I want to give some money to the church. I know if I give my normal amount, I can't itemize. But if I gave 2 or 3 years worth of donations in 1 year, I would at least get that for that year a benefit. But I want the charity of the church to get over that 3-year period. So people would give money to a donor advice fund, get the deduction in that current year because of these rules. They want to get over the standard deduction, okay? But they want the charity to get over maybe a 3-year period. So that's why those donor advice funds became very popular, actually, in about 2018. Okay, because I have lots of clients that ask me about, and I used to own a lot of rental properties. For some reason, people like to own rental property or think about it because they believe that there's a lot of tax benefits in owning rental property. That used to be the case, but I'll explain to you why that may not necessarily be the case as much as it used to be maybe back in the 80s when I was buying a lot of real estate at that point. And it's because of this rule. It's called passive loss rules. Passive loss rules came about, I believe, in 1987, basically because the tax rates back in then was 50%. It was actually 70% in the early 80s, but it came down to 50% in the 86, 87. So you had a lot of high-income people going out and doing different types of investments to get deductions. I mean, 50%, I mean, it wouldn't take you long to get the 50% tax bracket. So when Congress then passed this passive loss rule that basically says that you can't use passive losses against other income, wages, 401ks, you can't use passive losses against other income. And rental property, by definition, is passive. So you can't use losses against other income to offset your taxes. You say, well, wait a minute, Brad. I know someone that takes rental losses all the time. Yeah, there's an exception to that rule. The exception to that rule is if you actively are involved with the real estate rental property, you can deduct up to $25,000 against other income. So the rule is passive losses. You can't take it. The exception to that rule is you can take $25,000 in losses against other income by real estate. And Congress, in their wisdom, makes an exception to the exception. Okay? The exception to that exception is if you make over $100,000 up to 150, you can't use that exception. So passive loss you can't. Real estate, 25,000 you can. If you make too much money, you can't. So that's why when clients come into my office and they think I want to invest in real estate, we got to be careful that they'll get a benefit. And here's kind of an example here. And I understand that these numbers aren't exactly accurate because you wouldn't be in the 24% bracket at 180 as you saw in the other charts. But as an example, I want to give you an idea how this works and why other things have become more popular. Okay, let's say you buy a rental property for $200,000, and I'm breaking down $50,000 in land which you cannot depreciate. A house, $120,000 of that 200 you can depreciate, and then appliances and carpets and windows and $30,000 which you can actually now write off. And that's why a lot of people are looking at rental properties. You can write that off. So your total of $200,000. However, remember, the income is 180. That's very important because of the rule I just told you. Okay, very important. So if you had a normal rental property, your loss would be $31,000 because you have rental income, mortgage interest, taxes, insurance, depreciation, all create a loss that that's why a lot of people get real estate, is because they want to have a tax loss. $31,000, no benefit in the current year because their income was over 180 and they fell into that exception to the exception. They can't deduct it. Now, when you can't use it, the word is suspended. You don't lose it, but it's suspended until you either have passive income or you sell the property. Okay, so you don't lose it. But if you're doing rental property for tax benefits in the current year, you're not going to get it. Okay. Now, what's become very, very popular because of that tax rule is short-term rentals. I don't know if you heard about that or not, but short-term rentals is defined as the average rental period is 7 days or less. That's why Airbnbs are so popular, because they want the tax benefits. Airbnbs, maybe you rent it for 7 days and then someone else comes in. So, as an example here, similar numbers, I reduced the income a little bit by $5,000, thinking you may have a little more vacancies with a short-term rental. But you have $36,000 in losses, short-term rental. Short-term rental, by definition by the IRS, is not a passive activity. That's the difference. They consider that as a trade or business, not a rental property. So the short-term rental isn't automatically defined as a rental property, it's defined as something else. So you don't fall into the automatic definition of passive activity. Incredibly important if you're doing any type of investing in property, okay? So that's the big difference, that in this particular case, in the 24% bracket, similar numbers as far as investments. One saved you real money, $8,700. The other one you had was zero. So that's why you may see a lot of things that you see in business or in the world out here is because of tax rules, rental properties. So, I mean, donor advised funds. So that's a lot of things are wagged by the tax rules that are in our society. Any questions about that? I mean, it's a big deal. Okay, other topics I want to talk about, because I didn't know the topics that you'd be interested in, but retirement planning. And either retirement planning where you're funding it, which is different than taking money out. And most advisors, unfortunately, concentrate on the accumulation stage, and the pain is the distribution stage. That's where the pain comes in, because that's where it's all going to be taxable. If you have a 401k, IRA, simple, SEP, it's a tax time bomb. That's what it is. So So one of the values, however, before I get to my next slide, is the value of, I mean, you probably all know this, the value of retirement planning is time. I mean, the longer you've been, having money in a retirement account, the bigger it's going to be when you retire. I mean, you're already at retirement. So you probably have experienced that when you started, or if you started either early or late, your numbers could be, significant. And I do a lot of planning. I consider that more advanced planning because, and I'll talk about that a little bit here in a second. But actually, the types of planning are traditional IRAs, Roth, SEPs, Simples, 401ks. And of course, 401ks, one of the advantages of a 401k is, what's one of the advantages of 401k? Anything? There you go, employer match. So it's free money, usually if you're involved in a 401k. Unfortunately, you're adding to your tax time bomb. I mean, that's why I call for many times I've done presentations, I've called the qualified accounts, meaning 401k, IRAs, simple SEPs, the government plan for retirement. And why do I say that? Who sets the limit on contributions? Who sets the time when you can take it out without penalty? Who sets the age when you have to take it out? A government plan. So I try to encourage people to, again, we go back to the what's your priority? Is it short term or long term? Meaning, especially when it comes to Roth or other types of planning, is that it's the short term versus long term. If you want the short term benefit, 401k, reduce your wages. You save taxes. IRA, you contribute to an IRA, you save taxes. Unfortunately, when that all grows, maybe 30, 40 years later, it's all taxable. So it's, some people have talked about it being you get the deduction on the seed, you pay tax on the harvest. That's what's happening, because you get the small deduction on what you contribute, but all that grows to amount when you take it out, it's all taxable. So I do a lot of high-level planning to help people understand there are strategies that can help minimize the pain of maybe converting to a Roth. I mean, most people think, well, I got to pay tax on that. Yeah, that's true, but there are plenty of, and I do a lot of strategy with Roth conversions that most people don't have access to, and it can significantly reduce your effective tax rate. I did one yesterday, actually today, and again, these numbers may only apply to a certain amount of people, but it was a $600,000 conversion from an IRA to a Roth. I think his effective tax rate, what he would pay on that conversion, was 18%. That's a big deal. And it wasn't 35% like it normally would be, because it was a conversion that we did multiples of strategies to do, and that's why I try to help people to make sure they have an opportunity to do that. And the other reason why that's important, and a lot of times people say, well, I'm not going to get the benefit of tax-free money. That may be true, but a lot of times when you do a Roth conversion, you may be doing it for beneficiaries, because someone's going to pay tax on that money. And because of the Secure Act, and you probably all know this, but any non-spouse that inherits your IRA or 401k has 10 years to get it out, including growth. So if you have a son, daughter, grandchild that inherits your 401k or IRA, they have 10 years to get that to zero. And remember, we're in a progressive tax structure. The more you shove into that, the more you pay. So if you have a significant amount of retirement accounts, a lot of people do, and then they can't spend it out, and they're taking out their RMD, their required minimum distribution at age 73, and the growth offsets more than that, it's hard to get that down without paying a ton of tax. And so that's why, again, tax planning is, in those particular instances, is critical, and there are things that can be done to get that to be less painful. Another topic that I wanted to just touch on, because there are some ways to minimize that, capital gains. most people, I would say, will experience some type of capital gain in their lifetime, either from selling property, rental property, or investments, equities. They'll have some type of capital gain on that. So the rule with short-term or long-term is important. Short-term gains, it's ordinary income. I mean, you don't get any preferential treatment for capital gains. But long-term gains, there are some types of benefits. You can kind of see here, or on your chart if you can read it, that if you're in a certain taxable income, and that's where planning may come in again. Planning may come in again because you could possibly only have 0% on your capital gain if your income is at that level or below. Okay, so you could pay zero tax on your capital gain if you plan accordingly. Most people will pay 15%. That's what most people will pay because they're going to be in that income level, and the fact that the capital gain counts. So it's just not your income, it's your income plus the capital gain has to be below that $98,000 to get to zero. So, but anything above that is at 15%. So knowing those rules and understanding the thresholds, and you have some capital gains, is important to understand that that's a possibility to how to save some taxes and tax planning. Now, if your income is way high and you had a huge capital gain, and then you're going to pay 20% on, and most people think it's only 15%, it's 20%, okay? Plus, because the net investment income tax that came about with for the additional Medicare 3.8, no one's going to ever pay 20%. It's going to be either 15 or 23.8 because the 3.8 starts at $250,000 of investment income or income. So it gets complicated, but just keep in mind that normally if you're at 20%, it's going to be 23.8 because you're going to have the add-on of the Medicare tax to that gain. So again, planning is important to know those thresholds, and you can do some things to minimize that. And here's just a few things that may be ways to minimize your capital gains tax. One is to pay attention if you have losses, and most advisors may not tell you, so you kind of have to look at your portfolio. But if you have losses, you may want to go ahead and sell to basically hoard or harvest losses that you can use them later when you have capital gains. So that's one way to consider if you're trying to do some planning. If you have losses in your portfolio, nobody likes losses, okay? Nobody likes to have losses. Everything's going to come back and you recover. That's true, hopefully, but if you want to do it from a tax standpoint, maybe you want to sell those and take the loss. Now, you can't turn around and buy the same thing. There's something called wash sale rules. You got to at least wait 30 days. You can buy something else that's similar, but you just can't buy the exact same thing. IRS says, look, if we're going to give you a deduction for selling something, you can't be in the same position. Okay, you go buy something different, but you got to wait 30 days if you want to buy the same position. Okay, it's called wash sale rules. So, like-kind exchanges, those are still popular. You always get those questions. They're very complicated for calculating it, but if you have an investment property and you want to not pay the tax and defer it, not eliminate it, defer it, then you can buy something similar and take that gain and put it into the other property. It defers it. So you can't eliminate it from your gain. The other one, and this is a area that changed, called qualified opportunity funds, that I've had some clients utilize many years, well, 4 or 5 years ago. Basically, it says if you have a gain, whatever it may be, not the proceeds, the gain, and you put that into a qualified opportunity fund, you can defer the gain and not pay tax on it, okay? You have 180 days to decide that. So really right now is perfect because 180 days would get you into 2027, okay? So if you sold something today and at the end of the year, you find out, man, I'm going to pay a ton of tax. You can actually put that gain into a qualified opportunity fund, not pay the tax in 26 and pay it in 27, or when you take it out. So qualified opportunity funds give you the option of kind of maneuvering your capital gains around. And there's some new rules. Unfortunately, 2026, for all those people that did that for the last 5 or 6 or 7 years, they got to pay, if they haven't taken it out of their qualified opportunity fund, they got to pay tax this year. Because the old rule was you'll pay the tax on that gain when you take the money out of the fund, or 2026, whichever comes first. So I have clients now that are going to be stuck with the gains that they created back in 2019. They're going to pay tax on that gain in 2026. That's the old rule. The new rule, there's a 5-year, it's called a 5-year rolling time frame. So if you keep in there for 5 years from the time you sell it, you also get a 10% increase in your basis. And so if you had, say, something for $200,000 and your basis was $50,000, you'd pay tax on $150,000. If you put it in a qualified opportunity fund and kept it in there for 5 years, you actually would get your base would be $5,500. You get a 10% bump in your basis. So that's something nice to know. That's maybe out there if you got capital gains. But qualified opportunity funds have been around for I think 2019. So okay, that's capital gains. And one last topic here, and maybe you do or don't have a business or thinking about a business. Some people do, some people don't. But the type of entity that you have is important. It'll dictate how much tax you pay, whether you have a LLC, S corp, sole proprietorship. There's areas that they'll make you pay less tax. If you have rental properties, for example, I would highly recommend not having that in an S corp because of the tax rules. Most clients of mine will put it, if they want to have a rental property or rental properties in a entity, it'll be LLC because of the tax rules are different as far as how you can deduct things in an LLC versus an S corp. And so, there's plenty of pros and cons with each entity. The purpose of an S corp really, and LLCs, partnerships, S corps are all flow-through entities. They all flow through to your personal returns. So they usually don't pay the tax. S corporations, however, can help minimize Social Security tax. So if you're a sole proprietor, and everybody probably got a wage at one time, out of your wage, Medicare and Social Security was taken out of your check. 7.65% was taken out of your check. The employer matched it. Okay, they matched it, and they sent it into the government. So when you're a sole proprietor, you wear both hats. Okay, so it's 15.3% of your net earnings from a sole proprietorship. That's how it works. So if you made, and I've had a lot of people in my office in tears, not realizing, new clients that came in, not realizing that not only do they pay regular tax, they got to pay self-employment tax, and they made like $30,000, and they owed another $5,000 that they weren't expecting because of Social Security tax. So the purpose of the S corp is to minimize that pain, because you can take money out as a wage that's subject to Social Security tax, but the non-wage isn't subject to Social Security tax. Where if you're an LLC or sole proprietorship, all of it's subject to Social Security tax. So it's a big deal for most people, and that's why you see a lot of S corporations out there for operating businesses. A lot of S corps, LLCs more for real estate and that kind of thing. There are some LLCs that have ownership of businesses. And it used to be where it was pretty easy to figure out what you should be. The tax rules have changed so much that you really got to do some calculations to determine if it's better to be an S corp or LLC, because there's other things I won't get into that may have an impact that would change your mind. So to conclude, the 45-minute mark. To conclude, brackets matter. Brackets matter to determine. the value of your planning, because most strategies, there'll be some type of cost or investment to do, but you want to look at the cost versus the benefit, and brackets do matter, because I can give you the same strategy to different people, one in the 40% bracket, one in the 20% bracket. It works like a charm for 40%, it doesn't work for 20%. So brackets matter. Obviously, understanding the rules and all the options, you give you basically a general idea of some of the rules that can impact you. And then I always tell clients all the time, whether you're working with me or anybody else, whether it be an advisor, an investment advisor, or even a tax advisor, you got to make calculations. You can't go on someone's opinion or a guess. You got to run through the numbers and look at all the alternatives to see if it really can work for you. So again, maybe in this group, retirement planning, I think, is a big deal. I mean, for you and your family. And I have some clients that, look, my kids are going to inherit my IRA. They can pay their own tax. I'm not going to do anything. I'm not going to do anything early for them. I have other clients that say, if I can do anything that keeps the government out of my family's pocket, I want to do it, and everybody in between. So that's just some areas to think about, and because really the retirement is a tax time bomb, because someone's going to pay tax on that money. IRAs, 401ks, if you get it to Roth, that can help out for generations to come. So that's all I have. Any questions?
Questions that we have for Brad?
You talked quite a bit about the charitable deduction and donor advised funds. What about qualified charitable distributions?
Excuse me?
Qualified charitable distributions.
You mean going to a charity directly?
Yes.
Like from an IRA to a charity. That became popular because of the standard deduction.
Sure.
Because why? What that is a qualified charitable donation is where you transfer money from an IRA or qualified account directly to a charity, and you don't take the income, but you don't get the deduction. Well, if you understand why things work, and the standard deduction is way up here, and you take the standard deduction and not have to recognize the income, that's a big deal. So that that's been around because of once the standard deduction went way up, the qualified contribution deduction became popular because you can not recognize the income from the IRA and still take the standard deduction and still be way ahead. Right.
And it's also, you can make it part of your RMD.
Right.
Which
Yep.
keeps the numbers. But I really, one of the things we're doing in our current programming here is to encourage QCDs.
Absolutely.
Because you save taxes,
Right.
and you can use those taxes if you want to make a good
Right.
gift to charity.
Right, exactly. And it's very, very valuable to give people the tax benefit by giving money to the charity without getting the itemized deduction. You're just reducing your income. That's very, very, very good strategy.
Do you see any pitfalls to using it, or any reason that we should be careful? Because I think it probably is increasing for some charities. It's increasing their income.
I mean, obviously, you want to have the desire to give to a charity, obviously, and I have a lot of clients that do that, and I think it's mainly I would say the majority of my clients that do it are giving it to their church, usually.
Yeah, and the one thing there to remember, you have to have the gift, or not the gift, the distribution completed by the donee. I mean, completed on their books,
Right.
not just that you've
Right.
put that front door.
And the other thing to keep in mind too is many times what will happen is a lot of times people will get the 1099. They'll still get the 1099 for the IRA distribution. But when you do your tax return, you can check a box, at least on my tax report, you can check a box saying that went directly to a charity, so it takes it out of there off your tax return. So what you'd see on your front page of your tax return would be, I took $30,000 from my IRA indented on your tax return, but when you come over to the main part of your tax return, it shows 0, and it says QCD. So just keep in mind that if you're doing that, and don't freak out when you get 1099, because you will.
Well, can I change the topic just a little bit?
Sure.
One of the things you did mention were beneficiary designations. And could you expand on that a little bit, some of the problems you've seen in your practice?
Yeah,
and
most of the time, the question is about beneficiary designations and how important that is. And that could be IRAs, it could be life insurance, it could be trusts. And a lot of times what happens, either people forget about what they did, which is never a good thing. They haven't reviewed it for 30 years. Or someone passes away, or their family dynamics change, whatever that may be, good or bad. And so it's incredibly important to review your investments or your life insurance or your trust, if you have those, to make sure that the beneficiary that you thought you had are on the document. Because I've had clients that thought a certain person was a beneficiary and they were not. And because things changed over the 20 or 30 years the last time they looked at it. And so either spouses passed away, they got remarried, divorced. I mean, there's a lot of scenarios where if you don't change your beneficiary, you could be in for a big surprise that you didn't want to have. Yeah.
And does that also apply to savings accounts and checking accounts? Of course, you have to look at the bank's rules.
Yeah, a lot of times, most of my clients, I would say, probably have a joint account. So you really don't have a show of beneficiary on those checking accounts as much as you would on those other types of things. So you usually will go to the spouse upon death at least, or there's different people are signatories on the account. That's a bigger deal, especially if you're maybe are single and you have kids. It's incredibly important to at least get them on the account or let them be able to sign checks, because when you pass away, funeral homes want their money, okay? Yeah. And you have no way without going to court to get that money. At least if you're on that account, you can write checks to pay everybody that needs to have money for those services. And so I see that quite a bit, that someone forgot to do that. And I've had a lot of people in my office in tears because usually it's the spouse, and they've never done how to do it before. It's the first time through it. Well, I've dealt with a lot of people, so I handhold a lot of people, tell them, okay, we're gonna take it one step at a time. We're gonna do this, and then this, and this, and this. And so, but it's overwhelming to most people when spouses pass away, or parents at times. I mean, it just happens. Things are gonna happen, but it's hard for people to go through the practical part of it when they're still dealing with the emotional part of it. And beneficiaries are part of that. And you have to get blindsided to find out that somebody that you were at odds with, that's happened before, or a sibling or somebody else is going to inherit some money that you didn't want to have happen. Mm-hmm.
Other questions for Brad? Get microphone to Chuck.
Question on stepped-up basis.
Yep.
I say I have a farm put in the trust. I die. Does the trust still get the stepped-up basis?
Assuming that it's a revocable trust or grantor trust. You know, most people have a grantor trust, and it kicks in upon, I call it testamentary trust, meaning that it will go into the trust upon death, or it's a living trust, and it's in the trust already, and then you get a step up. Yes. Upon death, yes. And that's a big deal for people, is a step up. Now, at one time, several years ago, they were talking about taking that away, which would have been brutal for landowners, because that's a big capital gain issue. That did not go through. That did not pass, and so that was talked about that one time.
This is a kind of a finance, but also a tax planning. If you're early in the career and you're saving in a 401, but you also have an opportunity to put money in a Roth, is there a balance you would recommend between those two options to avoid taxes?
Yeah, well, I'm a big proponent of tax-free money. So I lean towards the majority going into either a Roth 401k or a Roth contribution if you have the ability to pay the tax, because you're not going to get a deduction. The reason why I say that is for a variety of reasons. One is we don't know what the tax rates are going to be in the future. And we got $39 million in debt. And so will taxes go up in the future in the next 20 or 30 years? You know, maybe. The other thing is that on tax deferred, someone's going to pay tax on that money. It's going to be you or beneficiaries, and it's going to get more painful. So I'm a big proponent of Roth contributions, Roth 401ks, or converting to a Roth. So I wouldn't say there's a balance, but I would say I would go heavy on the Roth. Mm-hmm.
Other questions for Brad? Do we have any questions online, Dylan? Okay.
Can you go into the Roth conversion a little bit more? Just kind of explain that. Is it?
A Roth conversion is where you have a IRA mainly, and it's going to be tax deferred. You got all the benefits of putting money into that account, and you want to convert that to a Roth. It's taxable at that point. So you can do as much or as little as you want to. So if you're able to pay the tax, and then from that point forward, that money will be all tax-free going forward for you and our beneficiaries. So, but someone's got to pay the tax. My point is that when I do high-level tax planning, I do other strategies to help minimize that pain, because most advisors, I would say, only want to do it when you're in a low tax bracket. I'm just the opposite, because I know from tons of planning, it's easier to save money the higher the income. It just works out that way. So I'm not in the traditional do a Roth conversion in a low bracket. I try to do it as high as possible and see if it makes mathematical sense to consider that. So conversion is basically getting it from a taxable vehicle to a tax-free vehicle. You got to pay the tax when you do that. And you can do as much or as little as you want.
Thanks.
Other questions for Brad?
So if I'm understanding correctly, so if you convert to a Roth, and you have income less than 98,000, does that mean that the taxes on that would be 0%?
No.
Okay.
That is not a capital gain issue. Capital gains are only at the 0%. That's as if you sold an investment that's non-qualified. Your investments converting from an IRA to a Roth is not a capital gain issue. It's an ordinary income issue. So there's nothing. You'll pay tax whatever. You'll just add an income to your other income.
It's not a capital gain.
It's not a non-capital gain issue.
Huh.
It has nothing to do with capital gains, Roth conversions.
Other questions for Brad? Just about out of time here, so.
Good timing.
Just to follow up with that, so then if you have income if you have retirement in a traditional 401k, say,
Mm-hmm.
and then as you're thinking about converting versus just taking a distribution, would that distribution then be within that, trying to keep it, let's say if you want to pay zero tax on it, would that then be in that category or no?
No, distributions or conversion are not capital gain issues.
Okay.
I mean, it's just ordinary income. It's ordinary income.
It's ordinary income. Mm-hmm. So if your income total is less than 98,000, then it would be 0%?
No. The conversion or the distribution has nothing to do with capital gain. This is going to be ordinary income. So let's say, for example, you got $100,000 in wages, and you want to convert 50,000. Your gross income is 150. Now, if you had a Tesla stock that you should invest it into, not in an IRA, a non-qualified investment, and you sold that, that's capital gain. And then your bracket will dictate how much tax you pay on that selling of that Tesla stock. So the conversions or distribution from retirement accounts have nothing to do with capital gains.
If you was to transfer stock from your IRA to a Roth IRA, would there be a tax on that?
Yes. Because you're going from an umbrella IRA to a different umbrella Roth IRA. You could transfer it in kind, called ACAT. You could have stock over here, you want over here. Once you transfer it from the IRA to the Roth, it's taxable.
But you wouldn't have any capital gains if you didn't
There's
sell
no capital
it.
gains. There's no capital gains on conversions.
Only death and taxes are certain.
What's that?
Only death and taxes are certain.
The capital gains would be if you held it outside any qualified account. You went and invested your money in a stock. It's not in an IRA, it's not in a 401k, it's not in a SEP, it's not in a simple. You just invested it and got the stock. That is a capital asset, so when you sell that, it's capital gain. So, because basically IRS is saying, look, you put money into an IRA, and we gave you a deduction for that. We're not going to give you any more. Okay, you got a deduction already for it. So when you take it out, we want it to be ordinary income plus all the growth. That's why they're saying we gave you a benefit. Rarely does the IRS give you something and not take it back later. You put money in, got a deduction, take it back out, it's income. You know, a company has wages, they pay someone a wage, deduction, income.
The employer donates to your 401k,
Yeah. Mm-hmm.
their donations also become taxable when you get it out, right?
Yep. They got a deduction, they're gonna make you pay the tax. Yep.
Okay, well, we're at time, so I want to say thank you to everybody who came tonight, everybody who's been here before, everybody who's come online and so forth. We want to thank Brad, and we hope that this has been helpful. These 7 sessions have been helpful. You can always go online or tell your friends, hey, or your sister, whoever. Go out to our YouTube channel on Aldersgate. You can watch previous sessions at any time. So if you have insomnia some night or whatever, you know, go out and watch one, or on a Saturday afternoon when you have time. So please join me in thanking Brad, and we wish you a pleasant evening.